These are two different routes for capital raising. And speaking for SPACs, you have to understand that in the case of a SPAC, the IPO money has already been raised and it's sitting in a cash box looking for a good target where to deploy and engage in a business combination, which is quite different from a traditional IPO. Also, in the case of a SPAC, the valuation for the Indian target is already agreed at the time of the business combination agreement signing, which of course predates closing. This is quite different from a traditional IPO, which remains subject to market vagaries and market risk. Also, unlike a traditional IPO, in the case of a SPAC, it's not just the Indian target that is selling its story to investors. It's also the SPAC sponsor, because the SPAC sponsor needs to stand behind the target that it has identified so that SPAC shareholders can vote affirmatively for the business combination. And these SPAC sponsors are fund managers with access to sophisticated investors and the deeper US markets, which is probably one of the reasons why you see higher valuations in SPAC these days than perhaps in traditional IPOs. In addition to that, the US SEC has more relaxed requirements for research reports and prospectus, which probably makes the SPAC market attractive and faster to time to market as compared to, let's say, a traditional IPO. If you look at India requires a 3-year profit track record, which is not a requirement for SPACs. And this makes the SPACs well suited for companies which have a high growth potential and with strong future projections. Well, that's the $170 billion question, isn't it? Look, there are headwinds and tailwinds. I think one of the macro headwinds is the US Federal Reserve rolling back quantitative easing, and that could have a cooling effect on equity capital markets. But then that could have an impact on equity capital markets in general and not just the SPAC market. I think the second is the tightening of SPAC regulations by the US SEC to take into account some of the litigations that we have seen in recent times. But there are some significant tailwinds as well for the SPAC market. I mean, you can't ignore the fact that there is potentially $100 billion of SPAC money that has already been raised looking for targets and waiting to be deployed. So there's a lot of dry powder that is out there. I think the other tailwind is that there is now a growing realization that there is a place for a SPAC market. It is an alternative to the traditional IPO model, which requires a profit track record and so on and so forth. And so the SPAC market works well for high growth companies. Tech companies fall naturally within that category. Asia today is an incubator for several of these future growth technology companies, and it is for that reason that you probably see Singapore and Hong Kong coming out with their own SPAC regulations. And not just in Asia, even England has very recently updated its SPAC regulations. So there is an interesting jurisdictional competition that's going on, which I think presents good opportunities for regulatory arbitrage. India too has notified SPAC regulations. India's IFSC, which makes rules for the gift city, has come out with these SPAC regulations for SPACs to be listed in the gift city. Now, of course, there are some other legislations that still require updation, notably tax and foreign exchange. And so this is still a work in progress. But just to touch upon what these SPAC regulations look like, they borrow from the US SPAC regulations, and here's some interesting takeaways from this. For one, the SPAC IPO has to have a minimum size of $50 million, which I think is a delicate balancing act, because if the SPAC IPO size had been made too small, then you would not have attracted large investors, the more long-term investors that are needed in a SPAC IPO market. And equally, if the SPAC minimum size had been made too large, then several startup, smaller Indian targets would not be eligible to participate in that business combination. So there's a delicate balancing act there. Also, the regulations have delved into balancing the incentives for SPAC sponsors vis-a-vis SPAC shareholders. For example, a SPAC sponsor cannot hold more than 20% in the SPAC. Also, the SPAC sponsor is not permitted to vote in the business combination shareholder vote. So clearly, Indian regulations have thought about some of these things quite carefully. And India too is going to play in the SPAC space, so it remains to be an interesting space to keep an eye out for.